Hello, everyone, and thank you for attending today's webinar, Liens from Deferred Estate Tax on Businesses, Irrevocable Grantor Trusts and Basis Step-Up, and Charitable Gifts of Business Interest. This is Steve Gorin, and before we begin, we wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, then I may answer it later via email. A copy of today's slide deck is available in the resource widget. For technical materials supporting the slides, please see the link to my newsletter, also in the resource widget. We encourage you to download any resources or links you may find useful. You can find additional answers to some common technical issues in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 hour of general CLE credit, and in Missouri for 1.8 hours of general CLE credit. The webinar is also CLE accredited in New York for 1.5 hours of experience and transition credit. 1.5 hour of general CLE credit in Texas is pending. We award CLE based on attendance for the entire 90 minutes. Due to changes in jurisdictional requirements, you will notice that we are no longer using automated pop-up attendance checkups. As required, we will display secret words in 3 multiple-choice polls during the webinar. You will be required to select today's secret word from a multiple-choice list. Please respond to these 3 polls to demonstrate your continued engagement and to earn your full CLE credit. We value your opinions and appreciate your attendance in the course. So, onward and upward to our presentation today. So I got 3 topics: liens from the deferred estate tax on businesses, and the whole point is a lot of people don't focus on not just the timing of when they pay their estate tax, but also if they do get an estate tax deferral, some of the consequences of that. We'll also talk about irrevocable grantor trust and basis step-up, since the IRS at long last issued a revenue ruling confirming its view that no basis step-up is allowed on the death of the grantor of an irrevocable grantor trust, and does not include their estate for estate tax purposes. And then we'll also talk about charitable gifts of business interests. There was a very important tax court case that just came out very recently, in which the court really handed it to the taxpayer a big loss. They had to pay tax on the sale of their business interest, and they lost the charitable deduction. So we'll go through that as well. So in terms of the materials, so as I mentioned before, you've got the slides and you also have the newsletter. And then in the newsletter, in the middle of it, you'll see a couple of yellow boxes, and you can download a link to the most recent version of my few thousand page PDF on structuring businesses, basically any issues that a privately owned business owner would face. At least I try to do my best. Let's put it that way. Okay. So here I have on slide 3 some instructions on how to navigate between the slides and the big PDF. I really encourage you not to try to do that and to just focus on the slides. But you do have those materials there for you to keep, so you can when you down afterwards, when there's things you might want to go back and look up, then that would be a good time to go back and have the slides open and have the big PDF open and toggle between the 2 of them. Okay, so liens from deferred estate tax on businesses. You'll see a better cross-reference on the next few slides. We're going to talk about Overview of Code Section 6166 qualification and the benefit of deferral. We'll talk about planning for the loss of that deferral when using a sale to an irrevocable grantor trust, and we'll describe estate tax liens, their effects, and how you can navigate them. So moving on to slide 6 here on possible estate tax deferral. So if the value of the closely held business interest exceeds 35% of the adjusted gross estate, then you can be eligible for an estate tax deferral. And we'll go over the details of that deferral in a moment. But I just wanted to point out that what qualifies for closely held business depends on certain relatively strict rules. They go into organizational structure and ownership and the conduct of a business. If you have a corporate structure, the rules are relatively straightforward. If you have a partnership structure, they are not necessarily as straightforward because you need to have active conduct of business at each level. A holding company doesn't quite cut it. In fact, if you have a corporate situation, if you have a holding company, then you may have a reduced deferral period, maybe only 10 years instead of the period I'm about to describe to you. So if you do have a parent company and operations are conducted through subsidiaries, it would be a good idea to have the parent company actually be running the subsidiary businesses or providing some very active services to the business. Perhaps some services that are integral to the business's operations, where you can say that the parent and subsidiaries all together have one integrated business. But again, if the parent is just a holding company, then you may wind up, losing either all of your deferral or have a shorter deferral period. Also, once the person dies and you're in this deferral period, if the business interest is disposed of, then that will accelerate the estate tax. Now, it doesn't have to be the whole business interest that gets disposed of. It might only be, just a half or so that gets disposed of. And lots of rules kind of go through what is a disposition and are there ways around reducing the possibility of a disposition. I'm not planning on going into that today. I'd be happy to discuss it as needed, but I just want to point out that just because you get the deferral doesn't mean that you're going to necessarily keep it the whole time. Also, you need to comply with all the requirements for making the election on a timely filed return. And if you don't, then you won't have a valid election. Now, it could be that you don't know whether the value of your business interest exceeds that 35% threshold because that you may come back with an appraisal report that says, oh, it was only worth 30%. But maybe on audit, the IRS might adjust it so it's worth 40%. So in that case, it's important to go ahead and make the election and just say that the election applies if the value winds up being more than 35%. And again, I'm just speaking colloquially here. I'm not trying to get into all the details here, because my point is not to try to teach you what qualifies for 6166, but to give you an idea that even if you do all this great planning to hope to qualify for it, that even if you do qualify for it, there are limitations, and we really need to go through that and understand it. So before I get into more on the liens, I just want to point out one of my favorite tools is a sale to an irrevocable grantor trust. Again, the idea of the irrevocable grantor trust, which we'll get into a little bit more later, is that the trust is outside of the estate tax system in terms of when the grantor dies, it's not including the grantor's estate. But for income tax purposes, the trust is deemed owned by the grantor. So that way, there's no gain or loss on the sale of the business interest to the trust. And also, when you're selling it for a note, and the, for example, partnership or S corp makes distributions to their owners to pay taxes, well, when the trust gets that distribution to pay taxes, the trust doesn't have any taxes to pay because it's a grantor trust. Those are all paid by the grantor. So the trust can pay down the note by using these tax distributions to pay, so that the note goes down, and then those taxes, when the grantor pays the taxes, they don't have the money anymore. So the note is kind of a wasting asset. As a tax liability, is incurred, over the years, that note just goes away. So that could be a really nifty strategy to use, but the concern is that now you have a note, you don't have a closely held business interest, so that does not qualify for the estate tax deferral. So you had a business that might have qualified for the estate tax deferral, and now it's a sale to irrevocable grantor trust, you've knocked yourself out. Now, you could consider doing a GRAT instead of sale to irrevocable grantor trust, but that has its own technical issues. So what you might consider doing is having the irrevocable grantor trust buy term life insurance. And the term life insurance will provide cash that the trust can use to repay the note. So if you had, for example, a trust that had $1 million in it, and then it bought a business for $9 million, so you have a $9 million note, and if you had $9 million of term insurance, then that trust would receive that death benefit, and it could pay down that note right away. And there's really two reasons for this life insurance. So one of the issues is, of course, that we need the liquidity to pay the estate tax. And so being able to repay the note right away when the grantor dies, that'll give the estate liquidity to pay the estate tax. The other thing is, I mentioned just a few minutes ago, that the tax distributions that the entity is making to the trust the trust can use those to pay down the note because the trust doesn't owe any income tax. Well, when the grantor dies, the trust is no longer a grantor trust, so the trust has to pay its own taxes. So the trust was counting on using those tax distributions to pay down the note, But oops, the grantor has died, and the trust has to use those tax distributions to pay its own taxes. So now a major source of cash to pay down the note has disappeared. So if you have life insurance, then the life insurance can replace the use of those tax distributions to pay down the note. So you need the life insurance potentially to pay the estate taxes to provide liquidity for the estate, as well as having a source for the irrevocable grantor trust to pay down the note. Now, it could be that you're not really worried about it because you don't think the grantor will die soon, or maybe the business is generating lots of cash and is distributing all of its earnings, so the trust has excess cash to pay down the note, and so maybe you don't need it. Another little caveat on this, which is not in my materials, is that when you do have a life insurance policy and the face amount decreases from one year to the next, there can be consequences to having too rapid a decrease in the face amount. And that's a matter of design, how you design the policy. And I am not an expert on that. I just know how to spot the issue. So if you do plan on having this decreasing term, you should have the life insurance agent discuss it with the life insurance company and the underwriter to make sure that it's okay to decrease it according to whatever schedule that is. All right. I mentioned that that qualifying for 6166 deferral is a highly technical thing, and there are a lot of gray areas there. And by the way, I forgot to mention when I was on that prior slide, on slide 6, you can see there's a highlighted ACTEC report there. That is actually a live link. So you can click on that live link and go to an ACTEC report that goes through all the issues about what we think are technical concerns with 6166, as well as providing a model statute that we would like Congress to adopt. Unfortunately, Congress talks about wanting to protect private businesses, and it does nothing to modernize 6166. So those politicians are just blowing smoke. So it is pretty aggravating that they're not trying to modernize it. The first report on this, I was in charge of this for ABA, Real Property Trust and Estate Law section, and this was like 2006, 2007 that we issued a report to the Senate Finance Committee. And that report gets citing when they do tax reform efforts, but they do nothing whatsoever to address the issues that are raised in that report. All right, so if you have doubt whether the state qualifies for deferral, then consider an extension of time to pay. I mean, my slide says and return is being extended, but whether or not the return is being extended for time to file, you should definitely consider an extension of time to pay and say, look, we think we qualify for 6166, but just in case, we don't want to have to undergo a fire sale of our business so we get pennies on the dollar. So please give us an estate tax deferral, which is under actually code section 6161. And the way that works is that the IRS could give you up to 10 consecutive one-year deferrals of time to pay the estate tax. And the regulations say that if you're asking for this deferral up front on your when you file it, not just when you get audited, but up front when you file a return, if you ask for that extension, and you would have to have a fire sale in order to pay your estate tax, that we are not going to require you to do a fire sale. At the same time, the IRS wants to see you going through diligent efforts to do the sale that's needed to pay the estate taxes. So we know, the IRS knows it takes time to do that. So granting the first year deferral generally should be relatively straightforward. But at the end of year one, they're going to say, hey, how far along are you in selling your business? Number one, why haven't you sold it yet? And number two, what's your time frame for selling it? Because the IRS doesn't want to be kept waiting. They're entitled to tax. You're late in paying it. And so you have to do the orderly sale if you don't get the 6166 deferral. So there is even if you do get an extension of time to pay, this interest is still due. The extension of time to pay merely would avoid having a penalty on that. Okay, what's the deferral? Interest is paid on the first and fourth anniversary of the estate tax return due date. So the estate tax return is due 9 months after death, and then on each of the first 4 anniversaries you pay interest, and then on the 5th through 14th anniversary you pay interest and 1/10 of the principal. And if you have a bequest to a skip person, which is generally a grandchild or a more remote descendant, there can be GST taxes due. 6166 does not defer the GST tax. Now, again, ACTEC has proposed that Congress should allow it to apply to the GST tax. But again, Congress says we care about small businesses, but having a state tax not cause problems with a small business, but those are empty words because they're not modernizing 6166. Okay, if you have the 6166 installment that's due and you don't pay it timely, then you may terminate the election and accelerate everything. So you need to take care of getting things done timely. And I have some details on how that works. So again, I'm being very general with this because you can read about the specifics. Okay, so today's first secret word is tax. Please select the correct word below. All right, on we go. So here you see that there's a secret automatic estate tax lien against the personal asset of the trustee of a revocable trust that holds a business interest. If you have a probate estate instead, then the lien applies to the estate's property and continues to apply to the property once it is sold, with certain exceptions. The lien lasts 10 years, except if and to the extent that the executor furnished property that was expressly subjected to the lien, and then that will relieve the lien to the extent of that property that was furnished. Now, if you have a 14-year deferral and a 10-year lien, then you've got a gap there. So the IRS is exposed on that. The IRS does review each return to make sure it qualifies for the deferral. So your 6166 deferral does guarantee that the IRS is going to be actually looking at your return in some kind of a substantive way. So because of this gap between the 10 and 14-year period, the IRS needs to be on top of it to make sure it's going to not get unprotected after the 10 years. So 6 years into the deferral period, the IRS will take another look at it. It could look at it sooner than that too, but it's definitely flagged for 6 years, and then it's annually monitored. And so the IRS will start asking questions. And as the 10-year expiration approaches, the IRS considers securing a replacement lien to cover the additional period. And if the government is at risk of not collecting, the bond or lien or enforced correct collection action has to be done before the lien expires. Now, when the IRS seeks to get an express lien, the estate can select security to be provided. And when doing so, the estate, you want to consider which property causes the least disruption with existing lenders or others with whom one does business, and also reduces the cost of keeping the IRS updated. Because now all of a sudden, all this property is kind of being exposed in a public way, and it's a little bit more than just the publicity. Because if ownership of the business is subjected to an IRS lien, and you think about there might be loan covenants or business line of credit, other borrowings, and you may violate the loan covenants. So, like the business owners, suppose the company has a line of credit or a bond or something, and the business owners are guaranteeing that. So it could be that placing a lien in favor of the IRS on the owner's assets might violate those loan covenants. So you have to be careful about that. Also, if you have everything in a revocable trust, the trustee of the revocable trust actually has the secret estate tax lien applied to their own personal assets. A very scary thing that's not well publicized. And so when they apply for their own personal credit, then they would need to disclose the liens for serving as trustee. So they may be having issues on being the trustee of the revocable trust and having this lien on their own assets. So it's a pretty gutsy thing to serve as trustee of a revocable trust when there's a 6166 deferral going on. So what are some of these credit arrangements? There could be a fidelity bond, like a construction company, and you need to, and so the liens could cause non-compliance with that. And if you're a construction company, you can't get a fidelity bond, then you can be put out of business. There may be a line of credit to finance inventory or accounts receivable, or maybe there's long-term loans for the purchase of buildings or equipment. And again, the owners might have guaranteed these things, and now the owners are slapped with this lien, and boom, you're out of compliance with it, and you've lost your credit, and you may have very deleterious effects on the business. If a loan is being refinanced with a new lender and the security interest arose before the decedent's death, then that seniors of the IRS's automatic lien. So let's suppose somebody did some lending transaction in 2022, and then the decedent dies in 2023. So the IRS's lien in 2023 is junior to that 2022 lien. And so if you are going to refinance that 2022 borrowing down the road, then you may need to have the old lender assign to the new lender the old lender's security interest because that 2022 security interest that gets assigned the new interest is still valid and still has priority over the IRS. So again, not all business structures are conducive to qualification. This can disrupt your business. It's best to avoid by using estate planning strategies now to be able to get out from under the estate tax. And between now and the time that those estate planning strategies have kicked into effect, so that you have enough liquidity to pay the estate tax, between now and then, you may want to use life insurance to fill the gap. And again, that might be the irrevocable grantor trust that buys the business interest, or it may be some other kind of irrevocable life insurance trust. Now, if you have a standalone irrevocable life insurance trust, you need to think about the fact, well, how does the estate get the money from the irrevocable life insurance trust? Well, it could borrow it, but it will still need to repay it. So most likely what will happen is that irrevocable life insurance trust will buy the business interests from the estate or the revocable trust or whatever. And so if you are doing the irrevocable life insurance trust for this point, you need to make sure the irrevocable life insurance trust has all the clauses in it that you'd want to have for holding a business. Even though the life insurance trust doesn't have any business interests, eventually it likely will, because it will buy those business interests from the estate to provide the estate with liquidity. So when you draft the irrevocable life insurance trust, keep in mind the fact that eventually it will probably hold a business interest. So just don't do some boilerplate. All right, so let's talk about irrevocable grantor trust and the fact that they don't have a basis step up. We'll talk about the lack of basis step up and particularly when basis step up is important. And then we'll talk about an alternative estate planning tool that you could use that lets you have basis step up and lets you shift the growth. So Revenue in 2023 confirmed the IRS's view that assets in irrevocable grantor trust do not get a basis step up merely because the deemed owner died. Now, a lot of people call irrevocable grantor trust defective trust, and I don't use that terminology because I'm hoping that my trusts are effective, not defective. But what you could have a trust that is defective, where it is included in the grantor's estate. So then you'd get a basis step up if it were defective in that manner. But hopefully we have effective irrevocable grantor trusts, and they won't be included in the grantor's estate, so there would be no basis step up. Now, it's good for clients or the other advisors to monitor the relationship between the value and the basis. And of course, it depends on how often the client comes back to us and whether we have a chance to ask these questions to them or not. And you have, different kinds of irrevocable grantor trusts. I mean, you have those ones with business interests with a sale going on, and so those are all great. You may also have irrevocable grantor trusts that are like just plain old received gifts or whatever. And if they have low basis assets, then it'd be a good idea for the grantor to swap out high basis assets in exchange for those low basis assets. Now, if you're selling a low basis S corp or low basis partnership interest, and when I think partnership throughout my whole discussion here, I mean LLC, limited partnership, whatever, any entity that's taxed as a partnership. So if you have those may very well be highly appreciated, but the dynamics of the tax distributions to use to pay off the note, those really want to make you, and the fact that they tend to grow really fast, those tend to make you want to leave those inside the trust even though they have low basis. But if you have other assets in the trust that have low basis, then it's a good idea to consider swapping those with the grantor for high basis assets. The other thing is if the grantor has gotten ill and they're about to die, then you might say, hey, we've had our irrevocable grantor trust do its stuff. Let's sell those assets back to the grantor, and then that will extinguish the note. It'll get the business interest inside the grantor's estate, but you're not going to be worried about getting the growth out of the estate because there won't be much growth between the time the grantor buys it back from the trust and the time the grantor dies. And that way you can get the basis step up. But you can't count on that occurring. So you need to consider the fact that there's a good chance that there might be an unexpected death in terms of the timing of it. Now, if grantor trust status terminates during life, it's a deemed bargain sale. The grantor has sold to the trust all the trust assets because the grantor was deemed to own those immediately before the sale. And the grantor is deemed to have sold all those trust assets to the trust in exchange for whatever note is outstanding to the grantor. Now, if the trust also has debt or is deemed to hold debt, then that debt is attributed to the grantor, and then when you talk of grantor trust status, they've been relieved of that debt. So that's also sale proceeds. Now, what do I mean by saying that the trust might be deemed to have debt? Well, if the trust is investing in a partnership and the partnership has borrowed money, then each owner of that partnership is allocated a portion of any debt that partnership has incurred. So you may have what I call here deemed debt, that maybe the trust isn't directly liable on that partnership liability, but that partnership liability is nevertheless allocated to the trust and therefore is deemed to be incurred by the trust, and while it's a grantor trust, that's incurred by the grantor. Okay, so again, turning off grantor trust status can have the effect of this bargain sale in exchange, where the grantor is transferring those assets in exchange for the sum of whatever note is outstanding that the trust owes the grantor and whatever liabilities the grantor is deemed to be relieved of. Now, what if grantor trust status terminates at death? Well, we don't know the answer. There is a chief counsel advice that suggests that there is no deemed sale at death. And I think it's good to think outside the box a little bit with this. Suppose you're selling to an irrevocable grantor trust that's exempt from, you allocate GST exemption to it, and it's totally outside the estate tax system forever and ever. And let's suppose that there's a low basis asset in there. Well, what happens if there's a deemed sale at death? Well, if we took the position that the grantor was deemed to sell it immediately before death, then you may have an income tax liability generated on the grantor's estate tax return, and then you'll get a deduction for estate tax purposes. And our irrevocable grantor trust now has a step up in basis because it was deemed to buy that property for whatever the amount of that note was. So it might be good to reduce estate tax and give the dynasty trust a basis step up. So I'm not saying that it always will be. I'm just saying that rather than knee-jerk saying, whoa, let's avoid this tax, or let's take the position we avoid the tax, you may actually want to incur that tax. And with that basis step up, by the way, might come depreciation deductions that can benefit the irrevocable, now non-grantor trust. So So you can have a tax hit at death that generates an estate tax reduction, as well as generating annual income tax deductions for the irrevocable trust. All right, so let's go on to the next slide. Think about depreciable real estate. Depreciation reduces the basis over time. Every year you have those depreciation deductions, and it reduces the basis. And so that creates a difference between the value and the basis. And actually, my second bullet point there, instead of saying book tax, I really meant to say the difference between the value and the basis. And so you have a difference between value and basis that automatically occurs through depreciation. And if the real estate appreciates, that exacerbates that difference. So you can kind of think about the family might depreciate real estate 3 times. So when the owner dies, the owner during life could have depreciated the property, and then when it passes to the spouse can get a basis step up. They get a basis step up when the decedent dies, and then the spouse can depreciate it. And if it's including the spouse's estate, then there's a basis step up when it goes to the kids. So the owner, the surviving spouse, and the kids, all 3 of them might be able to depreciate that property. So basis step up for real estate is especially important between those 3 opportunities to depreciate and the fact that depreciation exacerbates these value versus basis differences. So when you have an irrevocable grantor trust, so let's suppose you sold the business to the trust for $9 million and there's 0 basis. So on day, like if the grantor died the next day, you'd be losing $9 million of basis step up, and that could cost you, a couple $1 million or so of capital gain tax when the asset gets sold. And you gain absolutely nothing from the sale to irrevocable grantor trust. That could be another reason for wanting to have life insurance, just to cover the loss or lack of basis step up. That's not really an immediate financial loss necessarily, but it is something to consider. Now, let's say you had a $9 million business interest and it appreciates to $10 million inside that trust. So now you've gotten $1 million outside the estate tax system, but you don't have a basis step up on $10 million. So which is worth more? The $400,000 savings of estate tax on that $1 million growth, or the tax on the sale of that asset or loss appreciation deductions on that asset for the $10 million. So at that point, you really have still done some harm, because the estate tax savings of that $1 million appreciation has totally been insufficient to make up for that loss of basis step up. Now, Carlin McCaffrey put together a formula a long time ago, and here's the formula that compares the investment return to estate taxes and capital gain taxes and basis. So I'm not going to go through all the details of the formula. The formula is a great exercise, but it does not consider estate tax savings of income tax paid by the deemed owner of an irrevocable grantor trust. The payoff of that note using those tax distributions. The idea that maybe you're going to make a big gift before the estate tax exemption goes down at the end of 2025, which it's scheduled to do. Also, the fact that depreciation reduces basis over time, and she's using a capital gain formula. So we have a different lot of factors that her formula does not consider. So I'm not intending to criticize Carlin at all for that, because her formula is a great idea, and there's no way you can get a perfect formula for this. And I certainly wouldn't be able to present that formula to you in this webinar. Your eyes would totally glaze over. If they didn't already glaze over with what you have there, they would definitely glaze over in a more complicated formula. So I'm not at all critical of her for creating that formula. I'm just saying that if you're going to use that formula, you should understand that it doesn't consider all these other factors. So don't just use it for rote. If you've got marketable securities, if you just have stocks that you're, marketable stocks that you're talking about, that formula works wonderfully. If you're just going to do a gift to the trust of these stocks without any other dynamics going on. So it works wonderfully. So just take it with a grain of salt there. All right, today's secret word is trust. So please select the correct word below. Again, the secret word is trust. All right, thanks for bearing with us on that poll. So now let's talk about an alternative to irrevocable grantor trust, and that is a preferred partnership. So a preferred partnership lets you freeze an estate. I'm going to go through what this really means. But here's the benefits. You get a basis step up on the original value that is retained, and you keep the growth outside the estate tax system. And even though with most partnerships we're concerned about Code Section 2036, in fact, this is not vulnerable to 2036 in the same manner that other partnerships may be. All right, so what is a preferred partnership? So first of all, you have to have at least two different state law partners to be a partnership. One or more partners has a preferred interest, and one or more partners has a common interest. The preferred interest includes a capital account that receives a percentage return on that capital account. And that preferred return is paid generally before making distributions to partners who own the common. And the common interest gets a capital account plus a flat percentage of profits distributed after the preferred interest receives its distribution. So let's suppose that you had a $10 million depreciable building, and you contribute that $10 million depreciable building to the preferred partnership. And let's suppose the kids kick in like $2 million bucks, and they're going to get some common. The grantor would actually take that $10 million and would probably split it up between some common and some preferred. So maybe they would get, for example, $1 million of common back and $9 million of preferred. So that $9 million of preferred, first of all, has a capital account of $9 million. And let's suppose they were getting an 8% preferred payment back. So $9 million times 8% would be $720,000 a year. So the first $720,000 of income that's earned during the year would go to the senior generation who has the $9 million preferred. Then the senior generation has $1 million of common, and the kids have $2 million of common. So of the remaining profits, once you paid off that $720,000, 1/3 of it goes to the senior family member, and 2/3 of it goes to the kids. So that's the way that the common and the preferred would work. And now the preferred returns are not guaranteed. Rather, they're preferred distributions of cash from the operations. So because they're contingent on cash flow, they're considered more risky than mere loans, and they require a higher return. So it can't be the AFR. What you do is you look at preferred stocks in the marketplace, and then you compare your preferred equity here to the characteristics of the preferred stocks in the marketplace. And then typically, because you're a privately owned business, you're going to have a higher risk level than a publicly traded one. So you're going to have a higher required rate of return than what the preferred rate is in the stock market. So there is kind of a catch-22 here, that if you have a higher preferred return, that puts more stress on the partnership's cash flow, because there's this big obligation that the partnership has to pay this cash out, and what if the partnership doesn't generate enough income from operations to pay it back? So the higher the preferred return, the riskier it gets. And that's a catch-22, because if it gets more risky, then you have to have a higher return. So that's a bad situation there. Now, what are some ways to reduce the risk? Because we want the opposite. We want to show that there's a low risk to this, so you don't have to have a higher return. And so then it's easier to cover the cash flow. And so then you can say, hey, this is a lot closer to what's offered on the stock market, because it's a pretty risk-free cash flow. So first of all, if the preferred holder is also the general partner, then the general partner has more control over the cash flow, so it's less risky in terms of the idea that the partnership will actually make the distribution to pay the preferred cash flow. So it's very typical in these deals for the preferred partner to hold a general partner interest. Also, the more value you give to the common, the less stress there is on cash flow. Suppose in my example of the $10 million partnership, instead of having $9 million to the preferred and $1 million to the common, we had, say, $3 million to the preferred and $7 million to the common. Well, that $3 million preferred, if we took an 8% return like we were talking about before, that's only going to be $240,000. So it's a lot easier for the $12 million in my hypothetical example to generate that $240 and make sure that it pays that year in and year out. So you can adjust it so that the preferred is smaller, so you have a smaller amount to cover, and it makes it less risky, so you can have a lower payout on that preferred. So generally, again, the senior family member will keep the preferred as a general partner and will have some common. The irrevocable, you might, for example, make a gift of common to the irrevocable grantor trust, and then you're just giving away the growth to that irrevocable grantor trust. Now, Code Section 2701 says if you have a preferred partnership and you have at least 10% minimum value in the common, but when you go through those coverage issues I was talking about before, how you set what percentage is preferred and what percentage is common, you will find that it's going to probably be at least 15%, if not 20% or higher, that needs to be in the common. So generally that 2701 minimum value of 10% is not going to be a factor as much as the common sense design issues when you go to do this. So you're going to be working hand in hand with your appraiser, and you're going to be discussing with your appraiser, what if we had this mixture, what would be the preferred rate of return? What if we had that mixture between preferred and common? How would that come out? And then you just see what seems to work the best. So you definitely are planning this in conjunction with your appraiser. So if the common partner is not a grantor trust, you might start off with an irrevocable grantor trust, but when the grantor dies, then the common will not be a grantor trust anymore. So sooner or later, you're going to not have a grantor trust there. And when you have these returns, it could be that the company is reinvesting some of the money that it earned. So maybe, let's suppose suppose you had an example, in this prior example, we had the $9 million preferred and the $1 million common that the grantor had, and then maybe $2 million went to the kids. So in that example, we had a $9 million preferred and 8% return, $720,000. Let's suppose the partnership generated $1 million of cash, so the first $720,000 of income goes to the preferred, the remaining $280,000 goes to the common. Well, what if the remaining $200,000 gets reinvested for business purposes? So you'll have the common who are going to get taxed on that $280,000, whether or not they actually receive it, because they are going to get the economic benefit of that $280,000 sooner or later. So they're going to get taxed on that $280,000 even though they haven't received it. So it's a good idea to provide tax distributions for the common so that if the operating income does exceed the preferred, that they will get their taxes paid instead of having the whole thing reinvested. Now, because the right to receive preferred payments depends on cash flow is not guaranteed, then forming the partnership is presumed not to be a disguised sale. And you should not have an intent to redeem the preferred partnership interest, and you should not have an intent to cap the cumulative payments when you do this, if you want to rely on this exception to the disguised sale rules. So, I mean, it could be that you contemplate that maybe at some point it might be redeemed, but we don't want to hardwire that or do anything that would make that be like a step transaction. If it gets redeemed later on, then it gets redeemed. Now, the preferred payment needs to be cumulative to satisfy Code Section 2701. If you run a little bit shy in your cash flow, you need to make sure that the preferred payment is paid no later than 4 years after the due date. Otherwise, there's a deemed gift by the preferred owner. This is under Code Section 2701. Now, if you are running late and you need to make this payment within the 4 years, you could make an in-kind distribution of property, and that will not be deemed to be a sale. That's generally going to be a tax-free distribution. Now, again, there's no 2036 inclusion on the common. The transfer is from the senior family member. How do we get out of this? So basically, when Congress enacted Code Section 2701, they said, hey, we've got our estate freeze rules in here. You got to comply with 2701. If you comply with 2701, we're not going to deem you for that common. Only what you own of that common. So whatever the kids have, that's not going to be deemed. It's not going to be deemed owned under 2036 by the parent who set this whole thing up. Now, that's if you administer everything correctly. we know that clients can mess things up. Maybe they do non-pro rata distributions and give everything to the preferred partner anyway, more than they're entitled to. Maybe there's some kind of overreaching with the cash flow going on that is totally ridiculous. Then you could have 2036 inclusion. But if you run it in a business-like fashion and pay the preferred, and you document your business reasons for distributing or retaining the other earnings, and we have this done in a very business-like manner, then 2036 should not apply. Okay, so the other thing is, so again, to wrap it up, in summarizing the preferred partnership to the sale to irrevocable grantor trust, the preferred partnership does require a higher return, so you have a higher threshold for getting it back. You have a higher initial equity owner investment by the other owners. The sale of irrevocable grantor trust, you might see it with a gift of 1/9 of the amount to be sold. So and if you had an example of, if you're going to sell $9 million of stock, you give $1 million to the trust, so that you wind up having a $10 million inside the trust between the $1 million gift and the $9 million sale. And then you have equity of $1 million, so $1 million divided by 10 million is 10%. So that's kind of how the math would work. So you have kind of 10% equity in that deal. Now that's kind of the common framework. I'm not saying that for sure is going to work. I'm not promising that at all, but that is kind of something that is done within the estate planning profession. And that's based on some practical aspects of what the IRS required to issue a private letter ruling back about 25 years ago. Or was it 35? Anyway, I guess it was 35. But however many years it was, the preferred partnership, you're going to wind up having some junior equity of probably at least 15 to 20% compared to the 10% seed funding. So those are the two disadvantages: the higher required return, the higher potential equity investment by the common. Then there's you have the benefit of a new basis on retained preferred interest and any common that the grantor might be retaining. So that's a big benefit. If the irrevocable grantor trust holds a common, again, you might buy back the common if you get ill, but again, you don't know for sure that you can do that. And also, I don't recommend that the grantor borrow from the trust, use a note to the trust to buy that back, because there's some questions about what the note's basis would be in that circumstance. I would recommend third-party lending or some other way of financing that. All right. And by the way, I haven't received any questions at all yet. So let's go on to the third segment, which is charitable gifts of business interests. And so this is a 2023 case, and it had two main aspects: assignment of income rule and when the transfer of business interest is completed. I'm going to go over those. Now, the third bullet point, charitable planning issues unique to business interests, that isn't really related to the case at all. It's just something I added on for you because we're talking about a sale of a business interest. I might or might not cover that depending on how time goes. So let's go through and talk about this sale. Let's first talk about what the assignment of income doctrine means. So before even reading what went on in the slide, so let's suppose somebody is going to sell their business interest, and they've already agreed to sell it to a third party. And they transferred their business interest to the charity. And now the charity is stuck buying that, basically selling that to the third party. They've agreed to sell it. They had a legally binding contract to sell it to that third party, and the charity is stuck buying that. Well, from a tax perspective, the grantor has already earned that income by locking in the fact that you're having that sale to that third party. So the grantor cannot shed that income tax liability by giving away the sale, by giving away the business interest after the sale has been agreed to. So the tax laws say that the grantor is going to have to pay the income tax on the sale of that business interest, even though the charity is going to receive the cash from the sale. That's called the assignment of income doctrine. Well, how far along does the sale need to be before you're going to tag the grantor with paying the tax on the gain on sale? And there is a case called Palmer where the taxpayer had voting control of the corporation and private foundation. And under a single plan, the taxpayer donated shares of the corporation's stock to the foundation and then caused the corporation to redeem the stock from the foundation. So the court there held that the sale was not legally bound, and the corporation couldn't compel the private foundation to sell the shares to the corporation. So because there was no legal obligation, the IRS is not going to tag the donor with the sale because it wasn't too far along. So there had been a bunch of cases, and the IRS gave in with this Palmer case. So how far along is too far? What if you're almost all the way there? Well, there's a case called Rauenhorst, which was a regular tax court opinion, and the tax court said, yes, IRS, you listed all these facts about that the sale was really far along. And those facts might have made it, for all practical purposes, certain that the sale was going to occur. But there was no legal obligation to sell, and therefore we're not going to tag the taxpayer with that. Now, what happened in Rauenhorst is actually kind of par for the course now. So what happened was, back in, I think it was like the late 80s or something like that. I have a site in my materials. There was a big oil company merger that was going to happen. And they signed a letter of intent and stuff like that. But when it came through to implementing the sale, one of the parties backed out. And the other party sued and said, look, this was a done deal. You broke up. You didn't have a right to it. Give me my money. So then people kind of like, well, how far along does the sale need to be before we might get sued for that? So as a result of that case, whenever there's a letter of intent, nowadays the parties will always say, we're looking into this. We're going to do due diligence. We do have a binding non-disclosure agreement, but there is no promise whatsoever to sell the company until we actually sign the documents effectuating the sale. So for non-tax reasons, parties will say no binding requirement to sell until you actually sign the papers on the day of the closing. So with that as backdrop, you have Round Horse here, and the IRS made some vague allegations saying, look, all these things had happened, therefore we knew the sale would occur. And the tax court basically said, forget it, they weren't legally bound to sell, we're not going to tag the donor. You haven't gone through the sale agreement, all you have was your non-binding letter of intent. Now, this new case moved away from the language that I cited there. And it moved away from that because the taxpayer was playing games. And we're going to talk about the reasons about the games that were being played with it and why the court held the way it did. And I actually don't really blame the court for the holding. It is an unsettling holding, but I understand why the court broke with Round Horse. The court claims it did not break with Round Horse, but yes, it broke with it. And it had a good reason for breaking with it, but it did break with it. So now here is what the test is under this new tax court case. Number one, was it legal obligation? Number two, what actions have the parties taken to effectuate the transaction? Number three, what kind of contingencies are there to the transaction going forth? And number four, what kind of corporate formalities were required to finalize the transaction? So now we have a four-part test where the tax court is going to weigh the facts and circumstances. Now, in this new case, distributions to the owners and bonuses were paid in conjunction with the sale, concluding all the pre-sale financial transactions. So like the company promised to the key employees, look, if we get sold, I'm giving you a bonus. Well, the company went ahead and paid those bonuses even before the sale became legally binding. But that was kind of a prerequisite for the sale occurring. It couldn't really occur until they paid the bonuses. That was the party's deal. So they paid the bonuses. Also, the owners took certain distributions there from the company that they ordinarily would not have taken out of the company. So basically all of the pre-sale financial transactions had taken place, and all that remained was to sign the documents. So the court said, here you can see the quote here in the third bullet point. On the record, looking at everything, we're convinced that the donors' delay in giving the shares to the charity until 2 days before closing, that all the risk had been eliminated by then, and the sale was a virtual certainty. So we're going to tag the donor because they didn't give the shares until after these distributions of bonuses were paid. So here's today's third secret word, which is return. Please select the correct secret word below, return. All righty. Now I'm going to go into the timing of the gift and then get into some takeaways from the case before we consider moving on to the final bullet points I'd had. Okay, so there was a 2017 tax court case that said that the charitable income tax deduction is allowed only if the transfer satisfies 6 essential elements of a bona fide gift. Number one, the donor is competent to make the gift. Number two, the donee is capable of taking the gift. Number three, clear and unmistakable intention on part of the donor to absolutely and irrevocably lose control of the asset and lose all rights in it. Number four, irrevocable transfer of the present legal title and dominion control of the donee. Number five, a delivery. And number six, acceptance. So that's what the tax court said in that case. And this is also, it said in that case that this is the same elements that would be for gift tax purposes. So when I go through this charitable donation thing, you should keep in mind that this may also affect gift tax purposes, when a gift is made for gift tax purposes. Okay, now in this particular case, the court said, well, this is Michigan law, and so we have to, whether you have made the gift or not depends on Michigan law. And from out of all the factors in that prior list, the court did, by the way, the court did not cite that prior list. But the court says, we looked at three things under Michigan law: the donor intent to make the gift, and then actual or constructive, in other words, deemed delivery of the subject matter of the gift, and donee acceptance. So then the court went through those three things one at a time. The donor intent to make the gift. So you look at not only what the donor is saying subjectively, but you have to look at how reasonable that was in light of objective facts. You look at the reasonableness of the donor's testimony. You look at other witnesses who make statements. You look at what the donor has said, if they're called as a witness in the case, what was the donor's demeanor, and you also look at the overall facts and circumstances in the case. And if the facts in the case do not really bear out the idea of the donor's intent to make the gift, and think of that in terms of the timing of making the gift, the tax court's going to say, look, I'm not going to accept your self-serving testimony. I am instead going to look at the objective facts, and I'm not going to say you had the intent until the objective facts actually bear out that you had the gift was made. And in this case, the donor did not intend to make the gift at an earlier date. The donor did not really basically do everything to demonstrate intent until 2 days before before the actual closing occurred. What about delivery? So the delivery has to be unconditional and place the property within the dominion and control of the donee and beyond the power of recall by the donor. In this case, the donor physically kept the shares, but emailed a PDF of the shares to the charity, which was Fidelity Charitable, along with, and did it in a manner that the charity could present these shares to the corporation and exercise its rights as a shareholder. So in this case, an email of the PDF worked just fine, even though the donor kept the physical shares. What about acceptance? And by the way, the timing of that was also 2 days before the closing. What about the acceptance? Acceptance is presumed. Now, Fidelity had a policy that says, if we put one date on it in your acknowledgement and then you think it's an earlier date, let us know and we'll change it to the earlier date, and then you're on your own for proving it. Well, so Fidelity actually did backdate the receipt at the charity's request, but the fact was that Fidelity Charitable typically required receipt of stock certificate as a precondition to its acceptance. That was its policy. and that was a testimony of the that they saw. There's an email there from Representative of Fidelity Charitable, who I've actually known and I've worked with before, and so basically they said, we don't consider it a complete a gift until you've given us whatever we need to exercise our right to shareholder. And after they got the PDF of the stock certificate, they did in fact execute the purchase agreement under warranty of good title. So that constituted acceptance. So basically they did satisfy having the acceptance, but again, it was 2 days before the closing, and it was after all those other events had occurred. Now, in the Round Horse case, the court did criticize that the IRS made allegations of an informal agreement or understanding between the donees and other parties, and didn't really prove anything. They did prove a lot of facts that made it a practical certainty, but the IRS wasn't as specific. But here, IRS proves exactly how far along the sale was. So my view of this is the court is moving away from Round Horse and instead saying to taxpayers, you can't get a deal totally worked out, take all the economic steps consistent with being totally ready to close, then pause for a day to figure out who you want to be taxed, rearrange ownership, and then close with the new owners who will be taxable. They basically said that was just too cute. So again, this quote in the third bullet point, that's my view of what I think the court was thinking. It's not what the court literally said. Now, furthermore, the appraiser here was not qualified as a technical matter to be an appraiser under the rules. The charitable income tax deductions have specific rules for what is a qualified appraiser. The appraisal has to mention the qualifications, which it didn't. And then there's a matter of the date of the contribution. So the donor got a receipt from Fidelity showing a donation a month before before the shares were actually delivered through that PDF. And the appraisal had that month before date on the appraisal. So the tax court said the appraisal used the wrong date. It used that month before date instead of the 2 days before closing date. So can the taxpayer rely on an appraisal? Well, ordinarily, yes. The problem is the taxpayer furnished the appraiser with what the court viewed to be an obviously incorrect date. And so the taxpayer could not rely on the appraisal using that obviously incorrect date, and that it should have been obvious to the donor that the shares were not contributed. And so there is a quote there in the third bullet point. The shareholder knew, the donor knew, or at least should have known, that the shares were not contributed. So all the above factors together preclude substantial compliance. So the donor, not only were they taxed on the distribution, but the donor had the charitable deduction denied. Now, the IRS did not prove the penalty because the Taxpayers Council relied on Round Horse. So they basically said, look, as long as you do it before the closing, you're fine. The council did say, hey, don't push your luck. Do it a lot earlier than right before the closing. But the taxpayer decided to push it, and the lawyer did say, hey, we think you're okay under Round Horse. So the taxpayer, even though they disregarded the advice on what timing they should use, they still did get advice that it was legitimate to take the position that they did, and so the IRS did not get penalties. But the charitable deduction was denied, and a concern that I have is that if you get into an argument with the IRS over the date of the sale, and the tax court feels that the taxpayer that the donor was really trying to play games here, that the court might say, hey, the date on the appraisal was wrong, and so we're going to throw out that appraisal because the appraisal has to have the date of the transaction on it, and it had a wrong date. So I am concerned about that. I mean, in this case, there were significant other factors present. So I wouldn't say that this case stands for the proposition that using the wrong date due to a dispute over the law of what the actual date was, because that was a legal conclusion, I wouldn't say that automatically is going to disqualify the appraisal, but I am concerned that it might. So I do have really two concerns going on here: making the gift sufficiently in advance, and also checking out to see whether you have everything else done within the appraisal that's correct. So don't let clients skirt by on the appraisal. Make sure they have everything, and I tend to make sure that our firm will review the appraisal to make sure it meets all the formalistic requirements of that. And I also talk to the client about who the appraiser is going to be and whether they appear to qualify under the regulations. All right, so that covers all three of those topics. I'm going to answer a question or two, and then if I have time, I'll talk about the other things. But before I do that, I'm going to go to the last slide, and then I can back up if I need to. And just want to point out the various resources that we have available for you. If you don't subscribe to the newsletter, that second bullet point has a link that you can use to subscribe to the quarterly newsletter so you can get this PDF, the most recent version on a quarterly basis, again, always at no charge. I'm sorry, this is a July 25th webinar for second quarter newsletter. So my second quarter newsletter will come out sometime in early to mid-July, and then I'll be explaining it in my July 25th webinar. And there's some other resources that are listed there. So some questions. So one guy is arguing that the IRS's position that an irrevocable grantor trust should get a basis step up when the grantor dies, and I do agree with the IRS. I would say that when I go to ACTEC meetings, the overwhelming majority of ACTEC fellows believe that the IRS is correct on this. There's very few who do. So I think it's very much a minority position. If you want to take a position inconsistent with that, then you would definitely need to file an IRS Form 8275 to make a disclosure to try to avoid penalties. I don't think you could take the position of substantial authority. I personally think that with the weight of opinion in the estate planning profession, that it really is a fringe argument, and you have to have a reasonable basis for taking that. And I'm concerned about even having a reasonable basis for it. But if you think in good faith there's a reasonable basis, then that's up to you. Go ahead and file the Form 8275, and if the IRS attacks it, be prepared to be challenged on whether you had a reasonable basis or not. Okay. Then a question is, what do I think about death triggering a sale? Now, for that case, I do believe that there's substantial authority for saying that death does not trigger a deemed sale. And so I would feel comfortable taking the position that there is substantial authority for that, and you don't need to file a Form 8275 to not to report a sale on death, a deemed sale at death. So I am comfortable with that. So I have answered both of those questions, and now it's time to wrap up. Thank you for participating in our webinar. Please complete and submit the survey that we'll display at the conclusion, which will be in just a moment. And also, feel free to pass this along to your colleagues who are good practitioners, and you will get a link to the recording. People get that whether or not they actually attend. So you should always sign up for the webinar, whether or not you're going to attend, and that way you get a link to the recording, and then you can control where, you can fast forward through that recording. And so if you do want any of your colleagues to listen to parts of it, you can actually take the link that we're going to be sending you and then tell them what parts to listen to. So anyway, that's that. Please submit the evaluation, and I look forward to having future contact with you, and hope that you'll subscribe if you haven't. Thanks again.